Welcome back to another video, guys. I haven't really been active on my YouTube posting videos because I've been active in my mentorship program. I've been updating videos, I've been adding videos, and I've been helping traders out in our chat room. So in this video, I wanted to make a brief explanation on how I aim for an extra $500 per day, and I do this 2 times a week. So I aim for about $1,000 extra supplemental income trading options per week by using this safe strategy. I'd consider it a safe strategy. It has a high chance of working and working out in your favor. So that's why I use it for supplemental income on top of my own personal day trading strategies that I do use myself. And I go into more detail with that in the course, but that is besides the point for this video. So this strategy has to do with trading credit spreads, either a call credit spread or a put credit spread. And we're capitalizing, or we're getting maximum gain on our premiums from our net credit. Whatever our net credit is going to be the maximum premium that we're going to receive when the option expires. And the reason why I only do this 2 times a week is because, for those that do know how to trade options, if you were to trade an index option, so in this case, we're trading SPX, the S&P 500 index. Index options expire every Monday, every Wednesday, and every Friday. So this strategy involves us trading Tuesdays and Thursdays. The reason why we trade a Tuesday is because we're holding the option, we're holding the credit spread into Wednesday, and we're holding for expiration. And then we're buying on Thursday and holding into Friday. So for those that are beginners with trading options to those that are more advanced and understand some of the lingo, really fast, you have a call and a put. A call is a bullish position and a put is a bearish position. This strategy involves trading credit spreads, which is a little bit of the opposite because we're buying and selling the same call or the same put, but a different strike price. And what I mean by this is if you're trading a put credit spread, you're going to be a bullish position. Or if you're trading a call credit spread, you're bearish on the position and you're bearish on the underlying stock. So let's go back into the chart, and we're looking at the S&P 500 future, the E-mini/ES. And I look at this because it's traded basically 24 hours a week. So I could see overnight movement. I can see where the stock is heading. And then I look and I trade the S&P 500 index, or SPX. So let me go to a 30-minute chart. So what this strategy involves is looking at if I'm bullish or bearish on a position. If I'm bullish, I'm doing a put credit spread, and if I'm bearish, I'm doing a call credit spread. So in this case, looking at the E-mini, it's in daily demand. And what I mean by that is, let me just pause this really fast. I'm in daily demand. So what I mean by this is that stock moved into an origin area, an area where demand exceeded supply in the past. So all unfilled orders that are at that level, when the price does come back into that origin location, those orders are going to become filled, and the price of the stock is going to move up or down accordingly, whether you're talking about demand or supply zone. But in this case, we're looking at demand. And what I like about demand and supply zones is they give us a defined risk. We know the zone starts at 2970.25, and we know it ends down here. So you can do your credit spread and know where your risk is, and know what your maximum loss is going to be, and know what your maximum gain is going to be. But when we're doing a credit spread, you need to have a margin account. Because we're doing a net credit, we're selling something first, you need to have a margin approval, and you need to have an options trading account because we're trading the option of the S&P. So ES is in daily demand right now. This is something I want to look to long. So instead of outright buying a call option, just a single directional call option, I'm going to put on a put credit spread, right? Remember, put credit spreads are a bullish position. So I'm expecting the E-mini to bounce out of this area a little bit. Now, the day I'm on demand here, so I'm on this awesome feature with Thinkorswim is on demand. I could go back to any time, any day, any second, and go back like I'm trading that moment. So I'm back on July 9th, which is a Tuesday at 9:40 in the morning. I'm seeing that the S&P is getting nice volume to the upside. We're coming at a daily demand. It looks strong for a bullish move. So what I'm going to do is I'm going to go to the trade tab. I'm going to go on SPX, and I'm going to look to put on, remember I said, a credit spread. So you want to make sure the spread says vertical because we're buying two strike prices and we're longing one and selling one. That's what a credit spread is. You long one and you sell one. So I'm going to look at the 29.25 by 29.20. And I want to make sure I'm having a credit first. So I'm having a net credit of 20 cents. So the most I'm going to make if I were to buy 10 contracts, if I were to sell 10 contracts, let's say, is $200. So what I do is I aim for about $500 for every trade that I do put on. So I'm going to put on about 25 contracts. Now I'm not going to send this order in yet because I just want to do a little more explaining. So let's look at this. I'm buying, so this is a long 25 SPX July 10th, 2019 weekly contracts at a strike price of $29.20. So let's go back to the option. Now SPX is on the right and the ES, or the E-mini, is on the left. So now I just want to go and look at 29.20, right? So I have to keep zooming out. So 29.20 is right down here. So I'm longing a 29.20 SPX for tomorrow expiration. So anything above 29.20 or anything below 29, or anything above 29.20 on a long option for a put contract is going to expire worthless, correct? So we are above the strike price, so we're going to expire worthless if we close above 29.20. So we're doing a credit, so we capitalize on a stock. The credit of the two options is we need it to get smaller. So the most amount of money we can make is 20 cents on this trade. And we are also selling 25 contracts of the 29.25 puts. Gives us, right, a credit of 20 cents. So let's go back to the chart of the S&P. I'm going to duplicate this drawing, and I'm going to draw a line to 29.25. So what this means is we are playing a Tuesday. It's a Tuesday, and we're playing Wednesday expiration. I'm bullish on the E-mini, so I think the ES is going to come up, which means the SPX is also going to come up. They're in confluence with each other, right? So I will receive all 20 cent premium as long as the SPX stays above 29.25 by the time it expires tomorrow. So that's giving me 40 cents of wiggle room down, and I will receive full premium, full 20 cent credit if SPX closes above 29.25 by 4 p.m. tomorrow. So I'm going to go back to this trade tab. I'm going to confirm this trade. It's going to cost me $500. I'm in at 20 cents for 20 contracts, correct? So as long as SPX, right, we longed the 29.20 puts and we shorted the 29.25 puts. So there's a 5 cent difference in the strike price, or $5 difference in the strike price, 29.25 minus 29.20. It's a $5 strike price difference. So down here is our two lines. And as long as SPX stays above this 29.25 by the time it expires tomorrow, we're going to receive full 20 cent premium on 25 contracts, which equals $500. So it's 9:44 in the morning, 15 minutes after the open on the eastern side. It's 9:44, or basically 9:45. So if we were to fast forward to, let's say, 3:45, I wonder if we bounced off of this daily demand zone, right? Now this has to do with part of my own personal strategy is demand and supply. But now look at SPX. We're at 29.76. If I was to scroll back here, our lines are all the way down here. So we have to move down now 50 points by tomorrow, by close, for us to start losing money. The price, or ES or SPX as well, can start to move down. I don't care if it moves down. Let's see. let's say the price of the stock starts coming down here, then bounces, then comes back down, right? I don't care if it comes down. As long as it stays above 29.25 by expiration, I'm going to receive that full 20-cent premium. So now let's look. I'm up $375 the same day, which is about 6 hours later. I'm up $375, and I'm only missing about 12 cents of premium. I'm only missing about, no, not 12 cents of premium. I'm only missing about $125 worth of my position for me to receive the full credit. And I don't care if I want to receive the full credit or not. If you're comfortable up $375, fine, take your profits and close your position. But now I know I have wiggle room all the way down about 50 points for SPX to come to 29.25 for me to receive an extra. Now this is an extra $125 to receive full $500 trade, right? So I'm comfortable holding this into the morning. I don't care if we gap down on bad news. I don't care if we sell off in the morning. As long as we don't sell off that 50 points, I'm going to still receive full $500. So now this is July 9th. Let's go to July 10th at, let's say, 9:45 again in the morning, 15 minutes after the open. Let's see what happened to price. Okay, price gapped up, which is even better. Now it's 9:45. It's not even close to expiration. We still have the full day. The market just opened 15 minutes ago. I'm pretty sure I'm going to be close. Yeah, I'm full premium. I received full $500 premium. So now what I would do is I would go here, I would close, and I would buy 25 credit spread, right? 25 contracts. So it's not even 4 o'clock the next day where I would normally hold into expiration. It's just 9:45 the next day, and I could sell and receive full premium. Now there's no point of waiting till the end of the day because I already received my full premium, right? So now I received 500 today. Now I'm going to reset the account. I'm going to go to Thursday. Like I said, I do this 2 times a week. Let's go to 9:35. Now it's Thursday. I want to play Friday expirations. I'm going to go to ES, so I'm not even going to look at SPX. Let's just evaluate this like it was a brand new day, and I don't know anything. So I'm looking at a 30-minute chart. The 30-minute chart looks bullish above this 3,007.5. Let's look at a daily chart. We're in a consistent uptrend, we're making higher lows. 1, 2, 3. We are at an all-time high, making higher lows. Volume coming in, we bounced off demand, and now it looks like we're breaking the high here. We got nice volume the day before. So I'm going to look to put on another credit spread, right? It's Thursday. I'm going to put on another credit spread. Am I bullish or bearish on this position? I'm obviously bullish. I think the stock is going to come up. So what I'm going to do is I'm going to do a put credit spread. So I'm going to go to trade. I'm going to go to 1 day to expiration. Now I'm just going to browse a credit spread. I'm looking at a put credit spread, and I'm looking for something reasonable that it gives me a little wiggle room that if the price of the stock does come down, I'll be okay with it. I don't care if it comes down or up. As long as it stays above my credit spread, above my strike prices that I sold, I'm okay with. So it's at 3,000 right now. I'm going to go back to the options chain, and I'm going to look something that I could get for maybe 30 cents, 20 cents, 40 cents, something in that area. So I'll go back here, and I'm going to look at the 29.60. I'm going to look at the 29.55s by 50. Actually, I'm going to look at the 29.60 by 29.55s, giving me a credit of 15 cents. So I'm going to go here. I'm going to buy about 30 contracts. So it's going to be a little more than $500. So now we could go back, map out SPX. I'm going to put a box this time. So we are 29.60 by 29.55. So 29.60 by 29.55. It's close enough. So now the SPX has to stay above this price for me to receive full premium by expiration tomorrow. I'm bullish on the E-mini. I'm bullish on the S&P. So I'm doing a put credit spread. I'm going to put this trade on. It's going to 15 cents for 31 contracts I bought on accident. So that's going to be about $465 if I were to collect full premium. What makes this a high probability trade is that the SPX on a daily range doesn't really move 40, 50 points, the current market conditions up or down. It has a current range of about 20 points, 25 points. So I sold a credit spread, which is 40 something points down here. So it gives me that wiggle room that I'm comfortable with. So now I'm going to fast forward to the end of the day. I'm going to go to 350, 10 minutes before the close on a Thursday. And let's see what happens to price. Okay, I'll look at the E-mini. And the price was kind of choppy, came down, came up, came down, came up. So it was kind of flat today. It closed about where it opened, or it's about to close where it pretty much opened. So we could say it's a flat trade. It moved down, and yes, it moved up as well. I don't care. As long as it stays above, as long as SPX stays above this green box, I'm cool with. So I'll look, and I'm up $310, even though the price of the SPX remained unchanged. I bought it 15 minutes after the market opened, and it's about the same price of where I entered those contracts. So it didn't move up and it didn't move down, and I'm already up $310, and I already gained that premium already. So if I want to sell before the market closes today, I could sell and get the $310, or I can wait and hold on to this in the morning for maybe a strong gap up or possibly a gap down, as long as it doesn't gap down 40 something points, which is very odd of it to happen in this type of market conditions that we're in right now. So I'm going to go to 9:35 on the Friday, the day of expiration. And let's see, we gap up. We gapped up on E-mini overnight session, and we're gapping up on SPX. So now I probably should be full premium because we gapped up. We have 6 more hours till expiration, and the chances of it coming down 50 points now is very slim. So we all know trading, and we know options trading especially is all about timing and all about time decay. So we could say a probability of these becoming full premium are pretty high right now. And yeah, we gained $465. You could sell, you could hold it into expiration and collect your $465 full premium. That's putting on credit spreads. I do this 2 times a week, and I can make about $1,000, or I aim to make $1,000 per week doing this. You can aim for more. Instead of putting only a $500 target, maybe do a $1,000 target and do it 2 times a week. It all depends on what you're comfortable with. This is what I'm comfortable with. This is what I've tested before in the past, and it works. It has a high probability of working, has a high chance of working, and I just like doing this supplemental income, a part of my own personal trading strategy. Now, really fast before I stop this video, if we were bearish on a position, we thought the S&P was going to come down, we're going to do the same thing we did, but we're going to do a call credit spread, meaning we're capitalizing on a credit spread, and it is a bearish credit spread, even though we're doing calls, but we're shorting calls, right? So I hope this makes sense to you guys. You could leave a comment for any questions you have about this. Follow me on Instagram. I'll leave everything linked below in the description. It's at Ameritrade. I'm here for you guys. I'm here to help you guys with any concerns about this strategy or about anything trading related in general. So thanks for tuning in, and have a good one, guys.